What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is March 5th of 2020. Well, folks, I hope you all are having a fantastic day wherever you are. And in today's video, we're not only going to be diving in through cryptocurrency markets and talking about not only the rebound we've seen in Bitcoin, but also the preparation for the longer-term trend. But along with that as well, we're also going to be talking about equity markets. We're going to be talking about the continued fears around you-know-what that is causing a lot of fear in traditional equities. And we're also going to be talking about the Fed's swift response in trying to meet the economic needs that are going to be present in this growing time of fear. And outside of that as well, we'll also be talking about an interesting correlation throughout all of this fear between Bitcoin and gold. So we've got lots of things to discuss in today's video, but I want to let you all know real quick that this video is sponsored by eToro. Now, for those of you who may not know, eToro is a social trading platform that allows you to interact with a wide range of traders from across the world. And they not too long ago launched their copy trading feature where you can copy a lot of people, including myself. And the simple way you go about doing it is you view the stats of a given profile. You can see the performance on a month-by-month basis, the current portfolio holdings, as well as a chart of their overall performance. And if you like what you see, you hit the blue copy trader button and you'll trade alongside them at the exact same prices and at the exact same time. All right, so definitely check out that in the link below if you guys are interested. But I want to go ahead and talk about crypto markets right now because the broader players here, the large caps here, haven't had a nice couple of days here. Over the last couple of hours, we've seen Bitcoin tailing up around 4% right now, and Ethereum following its suit. Along with that as well, if you just take a look across the board on the market, energy really picking up steam. This is again one of our top 10 plays for the year, up nearly 40%, followed by Icon as well, up 23%. So we've got a lot of big protocols picking up here, such as Icon, 0x Protocol, Tezos, Kyber Network, and Quant, all doing really well right now in double-digit territory. So again, I'm really happy to see this. Again, Kyber's been one of our big plays as well. And if we just go across the board here on the market, most cryptocurrency plays, as Bitcoin is tailoring up right now, are in the green. So not a big shocker here. Again, recovering this on some of the losses that we had over the past couple of weeks. And I think we're going to continue to see a positive tone here, guys. I think we've really seen the bulk of this correction. There is a chance that we could come down to test this line of support that we'll take a look at in just a moment. But I really don't see us doing that right now. So again, this is the line I'm referring to. If you guys have been keeping up with the daily videos, you probably know that I've been talking about this range kind of being where we could see price going over the next couple of months. And after we get here towards May, towards the halving event, it is very likely that in a very short period of time, we're going to break out of this wedge to the upside and start tailing up towards new highs in this case, not only towards previous highs for 2019, but also past 20,000 from back in 2017. So again, if we take a look here on the weekly, again, not too much of a dramatic change. If we take a look at the daily, we can see we've had a nice few days worth of price action. I'm liking the fact that we're setting a higher low, and it seems that we have yet to come down and make support on this line. And I think that's a good sign because it showcases that buyers are not going to wait. In fact, we actually got buyers coming in before the last significant low here. So again, it's a telltale sign that markets are getting confidence, that people are not trying to wait too long for a correction. We're gone beyond the days of, oh, I'm going to be waiting for 6,000 or I'm going to be waiting for 5,000. The market is definitely in a much higher state of confidence than it was back a couple of months ago after the very severe correction that we had after the rally from 3,000 up to 14,000, right? So again, with all of the kind of excitement we had back here, don't doubt for a second, guys, that can return back. In fact, one thing that I want to emphasize here that we talked a little bit about in a previous video was kind of the midway corrections on this greater rally we had in 2019. Again, we had a great rally where we went from around 3,100 to 14,000, and we can very much get a similar level of confidence here. I mean, this is really the base we're working with here, where we had a triple bottom, or more of, I guess, a double bottom here. If you want to include this bottom here, it would be a triple bottom. But anywhere from around 6,900 down to the low 6,000 range, around 6,500. And then now we're up towards 9,000. So again, we've got a lot of room to go on this. The correction we saw of nearly 20% is normal. It has happened in the past. We had a 17.75% correction here and a 23% correction within a matter of 2 days. This has happened on Bitcoin before. And the problem is, I think that I see a lot of traders out there, guys, especially people who are focusing on the short term or who have an incentive for you to fret about day-to-day price action. focusing and basically painting a picture that this is not normal in markets. This happens all the time in Bitcoin, and in fact, the volatility over historically, the price action historically in Bitcoin has been showing on the longer term time frames a decrease in volatility. So if this is too much for you guys to stomach, it might be that too much of your portfolio is in crypto markets. And that's the case for a lot of people. But again, you've got to determine for yourself what is right for you to hold and what you can emotionally handle. I haven't been doing any crazy trading, guys. I've been riding on my positions right now. I've been doing great over the last few weeks, and I'm excited to continue seeing the market growing over the next couple of months as DeFi expands, as enterprise blockchain continues to grow. There's a lot of positive and bullish narratives for the space that are coming with real fundamentals. So again, don't let the noise get in the way of that, guys. And again, just kind of on the logarithmic growth curve, I think there's a lot of data science models we could look at. This one is more of a, it is kind of a mix between a technical indicator here, which is really focusing on the correlation of price within the kind of logarithmic curves that have kind of been formulated over the last 10 years of Bitcoin's price. But along with that, it has this oscillator here that showcases where we are in the sense of the bands that have shown historical significance of the highs and the lows for Bitcoin. And the thing I want to really stress with this chart here is that it can be a very long period of time before we really start to see Bitcoin breaking away from that support line, which bear in mind is increasing. So that's already good news as is. But when we break away from this line, it tends to be that we're entering into the bull market and the price is entering into new parabolic levels, right? We can see here back in the last cycle, we set the final bottom here on the oscillator down here in September of 2015, right? So this happened a very long time ago, but not even taking it into the context of where we are now and where that was, it's important to note that it really took until about March of 2017 to really break away from this line of support, right? We were riding along this for a very long period of time where we had steady but slow gains for Bitcoin. And basically it took nearly about a year and a half in this case. If you give or take, again, you could be more specific about it, but about a year and a half. And we set our low for this cycle back here in February of 2019. So again, it wouldn't be surprising. It wouldn't be surprising whatsoever to think that we're going to get something sometime between May, when the halving officially is registered into the Bitcoin blockchain, where the reduction of new Bitcoin issued every 10 minutes is cut in half, and also somewhere between the summer of some sort, a couple of months afterwards. So I would say somewhere between July or August. That's when I really think we're going to get that significant break out of this move here, where again, even after the halving, we might correlate within this price action, and then we get a continued breakout. And I think at that time, it's going to be very difficult to find plays that outpace Bitcoin. I think we're getting a premature altcoin cycle where there's a lot of potential opportunity right now for risk taking. And when it comes to that halving event, and when the Bitcoin kind of supply shock kicks in, we're going to see a very, very big pickup in Bitcoin beyond 20,000 and beyond to highs that we haven't seen yet in cryptocurrency markets. So very, very big point to keep in mind. And just keeping in mind with the structure of Bitcoin, the history of the halving and the significance that it has in the sense of price action only after the fact. Again, we've talked about trying to price it in. You can't really price in the Bitcoin halving event until it actually happens, until that supply shock arrives, because the vast majority of people do not understand or keep up to date with the data science models, with the all the data and the understanding of Bitcoin that we have in the space, guys. We are a niche group of people. And it's the same reason why the last two times the halving event wasn't factored in, because people just generally don't know about it. We know about it, but we're a smaller group of people. That's a point that I always try to stress. They're like, I'll leave this off. This is my last point on it. People will basically say, oh, Nick, crypto markets are highly efficient nowadays. How have they not priced it in, right? And it's the same point. You can always say, well, why didn't we price in all the other halving events? Why didn't Bitcoin start out at $1 million? And it's because this is a new emerging asset. And just because there's a guaranteed supply shock that's going to be arriving, not only do a variety of people not understand that that's going to happen because they just don't know, but along with that as well, at the end of the day, Bitcoin is still a new emerging asset. People aren't just going to give it $1 million because, there's, going to be a supply shock to it, right? So there's a lot of factors. It's very subjective. Market value takes time to really be discovered or to meet back to its fundamental value. And right now we're exactly where we should be. And when it comes to the next halving, it's going to lead us towards a path of $100,000 per Bitcoin if the data science models are correct or if history in this case repeats itself. All right. So let's go ahead here and talk a little bit about equity markets. Now, I thought that LMTR here, this is one of the websites we tend to look at here for a lot of the really cool charts for things covering equity markets of the traditional economy. LMTR did a really good piece here talking about you'll wish that the short sellers were still here. And as you guys know, short sellers are people who bet against the market. Now, basically, this is just kind of a piece that was put together by Brad, who basically talked about all of the kind of worrying signs here. And this really kind of describes, I think it serves as a great template for the points that I've tried to present in regards to talking about the global, issue that's happening right now. Sorry, I'm not saying the term, guys, because YouTube's being real funky with anyone who talks about the thing that's spreading right now. Anyways, long story short, you guys know what I'm talking about, and we're entering into a period of time where we've got a very interesting set of events. We've had the longest economic expansion in the S&P 500, not only in the sense of like a time period, right? We've gone over nearly 11 years, but along with that as well, we've had the largest percentage expansion, right? Now you could say that the NASDAQ had a bigger expansion during the dot-com bubble. You can nitpick things and pick different indices, and that's fair, right? I guess that's true, but in the case of the S&P 500, a broad index that measures the performance of the broader equity market, we have entered the longest and the biggest cycle we've seen in history for the United States. This is absolutely significant. Now, taking this into mind, understanding the kind of magnitude of this cycle, along with that, we need to consider the fundamentals. We need to understand what's carried this market. And as you guys might know, as we've talked about since back in October of 2018, stock buybacks and dividends through DRIP programs have been propelling stock markets higher. And those have only been possible, the ability of companies to buy back their own shares through stock buybacks to apply buy-side pressure for their own equities. And along with that, dividends through dividend reinvestment programs applying continuous buy-side pressure for equities are now no longer going to have the same kind of fuel and kick that they used to have, because not only are valuations higher, so it takes a higher level of liquidity to continue pressuring equities higher, but along with that, we have a decline in corporate earnings. We've seen the first significant decline here in the last quarter in equities, in the sense of corporate earnings for U.S. equities that we've seen since back I think it was in 2015, right? And the important thing to note here is that forward guidance here for the next month, to the next 3 months, to the average guidance, we are seeing a sharp decline, the biggest decline we've seen since back in 2015, and to levels we haven't seen since back in 2015. So this is very significant, because when corporate earnings are declining, and that means you're going to have less stock buybacks and less dividends being paid out, this means less buy-side pressure for equities, less reason for investors to be confident. And again, that's almost a double whammy effect, because people have been relying solely on this kind of guaranteed buy-side pressure. When they see that that starts to get pulled back and prices start to decline, if there's no real market buyers and there's a lot of market sell-side pressure, well, you get an imbalance between supply and demand to sell equities, a lack of, supply of buyers in this case who actually want to prop up equities and purchase equity positions at such high record valuations. So that's what we're seeing here, guys. We're seeing a big mess here. And here's the interesting thing. We are seeing nearly no short sellers in the market. Now, again, as we hinted, for those of you who might not know, it's not an issue if you don't. Short sellers are people who are betting against the market. You could, for example, on some derivatives platforms, you can short against Bitcoin, and you can bet that the price is going to go down, and you can make money off of it, right? And the same goes for equities, right? But in this case, we are seeing the lowest amount of short interest on the S&P 500 ETF, the broad index ETF that gives you exposure to the S&P 500. The lowest levels of short selling in record history since back in 2007. So, just looking at this chart here, right? So let's think about it logically. If you see the lowest amount of short interest, just like we saw back in 2007, and proceeding afterwards in 2007, we saw a massive increase in short selling interest. You know what happened in 2007 and 2008 and 2009. Where do you think we're heading? Right? Again, this isn't a foolproof indicator, guys, that we're hitting a recession, but it's a telltale sign of where we are in the sense of the risk to reward profile of equity markets. There's not much left to make in the sense of returns in the short term. there very could well be a rebound in equities. We've seen over the last few days, we've gotten a little bit of a kickback up in equities, as I think we've seen not only the Federal Reserve, for example, who have not only continued to cut interest rates since back in mid-2019, but have announced that they're going to be cutting another 0.5%. And then also as well, from what I've seen so far, I won't say it actually, you know what it is, has basically been seeing a decrease in the overall amount of deaths. It's in the sense of the growth rate here, right? We're not seeing anything crazy. We haven't seen the S curve really kick off yet that we've been expecting globally. But all in all, right, even though there are some positive things, no doubt this is going to cause a suppression on global growth. And I can tell you all one great example that's relevant to our industry: conferences. I mean, I've been talking to a lot of close friends and a lot of people as well I know who are running their own organizations and conferences, and the vast majority are getting canceled for the next coming year and being pushed back towards either the end of the year or into 2021. And this is a big chunk of the economy, the events industry, the traveling industry. If these parts of the economy are suppressed due to concerns of what's been spreading as of recent, then we are going to see a massive shock to the global economy, and other dominoes will start to follow as well. It's not just these industries. So again, it can be a small portion of this that can lead to a very, very ugly outcome for global markets. And the interesting thing is that we're still continuing to see gold climb higher and also Bitcoin climb higher. In fact, what I really like seeing here is not only that on the longer term time frames, we're seeing a general correlation in the increase of gold as well as Bitcoin, but you can take a look here on the daily time frame and notice the correlation here on the days where we're pulling back, right? We have these days where we have Bitcoin in the red, and then also right as gold starts to reverse, Bitcoin is acting in a similar nature. And this has all been coming around something as well that's been bubbling under the surface, and we've talked about it. It's the growth in negative yielding bonds. As we've seen a growth in negative yielding bonds since back here in November and December 2019, the increase back towards more negative yielding bonds and the trillions of dollars, gold, Bitcoin, and silver have all correlated in a positive nature because they're a hedge against assets that are yielding you a negative yield, right? You know, in the case of Bitcoin, gold, and silver, they may not yield you anything like a dividend or interest, but they sure as hell are helping you hedge against inflation in traditional monetary policy, and they also are not giving you a negative yield. So when you have trillions of dollars in negative yielding bonds, you've got overinflated equities, property values, different types of assets, and bonds that are definitely entering into the twilight zone. Well, there is Bitcoin. So that's going to be it for the video today, guys. One thing I wanted to share here real quick that I almost forgot to mention: TaxBit is doing a competition where they're giving away 3 different tax packages. So if you guys want to enter in for a chance to win in that competition, feel free to fill out the form down below and enter in for a chance to get your taxes done this tax season. Anyways, that's going to be it for today's video, guys. Thank you all so much for watching, and I'll see you all in the next one. Stay tuned.